Before we begin, a quick and important disclaimer. This video is for educational and entertainment purposes only. The discussion regarding 401k accounts, legal proceedings, and marital dissolution involves complex financial, tax, and legal frameworks that vary significantly by state jurisdiction and individual circumstance. This content does not constitute legal, financial, tax, or investment advice. Dividing retirement assets can have long-term impacts on your financial security and tax liability. You should conduct your own due diligence and consult with a qualified family law attorney, a certified financial planner, or a tax professional before making any decisions related to your retirement accounts or divorce settlements. Imagine walking away from a 15-year marriage and realizing that half of your future has just evaporated. In the American West, this is not just a fear, it is a mathematical reality. Most Americans believe their 401k is a personal vault, a private sanctuary of wealth built through their own hard work and disciplined contributions. But in states like California, Arizona, and Nevada, that vault has two keys and one of them is held by your spouse. We are currently witnessing a massive shift in how the silver divorce is stripping away retirement security from thousands of people who thought they were protected by the desert sun and Western independence. If you live in a community property state, the law does not care whose name is on the account or who earned the salary. The law views your 401k as a shared harvest, and the harvest is about to be split right down the middle. This is the Deep Dive Masterclass on the 401k divorce in the American West, and what you learn in the next few minutes could be the difference between a comfortable retirement in the mountains and a decade of extra labor you never planned for. Today, we are solving the mystery of the Qualified Domestic Relations Order and the specific regional traps that catch Westerners off guard. We are going to break down why the geography of your divorce matters as much as the balance of your portfolio. We are moving beyond the surface-level advice to look at the granular details of valuation dates, tax penalties, and the brutal reality of how the American West handles marital property. To understand why the West is a unique battlefield for retirement assets, we have to look at the legal architecture of community property. While most of the United States follows equitable distribution rules, where a judge decides what is fair, several Western states operate under the strict mandate of community property. This includes California, Arizona, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In these jurisdictions, the starting point is not fairness. It is 50-50. Every dollar deposited into a 401k from the date of the wedding to the date of legal separation is considered owned equally by both parties, regardless of who worked the overtime or who chose the investment funds. Let's look at a case study involving a tech professional in Seattle. For 12 years, this individual contributed 10% of a six-figure salary into a 401k, while their spouse managed the household. Under Washington state law, that account, which may have grown to $400,000, is not his or hers. It is theirs. The complexity arises when we look at the premarital portion. If you started that 401k 5 years before the wedding, that initial seed money is your separate property. However, the tracing process required to prove what was yours before the marriage is an administrative nightmare. You cannot simply point to a balance. You have to account for the growth and interest on that specific separate portion over a decade of market fluctuations. Without meticulous record-keeping, Western courts often default to the assumption that the entire pool is community property. The most critical tool in this process is the Qualified Domestic Relations Order, or QDRO. Most people think a divorce decree is the final word. It isn't. Your 401k provider, whether it's Fidelity, Vanguard, or Charles Schwab, is governed by federal law, specifically ERISA, the Employee Retirement Income Security Act. They do not have to follow a state court's divorce decree. They only follow a QDRO. This is a separate legal document, drafted by a specialist, that instructs the plan administrator exactly how to carve out a portion of the account for the alternate payee, which is the ex-spouse. If the QDRO is drafted incorrectly, the consequences are catastrophic. For instance, if the order fails to account for market gains or losses between the date of the divorce and the date the funds are actually moved, one party might end up with a windfall while the other takes a massive hit. In the volatile markets we've seen in recent years, a 3-month delay in filing a QDRO, while the S&P 500 swings 10%, can mean a difference of tens of thousands of dollars. Furthermore, we have to discuss the separate property leakage that happens in the West. In states like Arizona, there is a legal concept where separate property can become commingled or transmuted into community property. If you took a loan from your premarital 401k to pay for a down payment on a family home in Scottsdale, you may have just converted that separate retirement asset into a community asset. The court may rule that you intended to gift that money to the marriage, effectively forfeiting your claim to the original separate balance. Now let's talk about the specific tax traps that occur during these transfers. Normally, taking money out of a 401k before age 59.5 results in a 10% early withdrawal penalty plus standard income tax. However, Section 72(t)(2)(c) of the Internal Revenue Code provides a unique divorce loophole. If money is moved via QDRO, the 10% penalty is waived for the spouse receiving the money if they choose to take it as a cash distribution rather than rolling it into an IRA. This is where many people in the West make a high-stakes mistake. They see the cash as a way to pay for their new life or legal fees, forgetting that while the 10% penalty is gone, the standard income tax still applies. If you are in a high-tax state like California, and you pull $100,000 out of an ex-spouse 401k to buy a new car or pay a deposit on a condo in Santa Monica, you might see 30% or 40% of that money vanish into state and federal taxes by the following April. Historical trends in the American West show that real estate and retirement accounts are often traded against each other. A common scenario involves one spouse keeping the house in Denver, while the other keeps the 401k. This is known as an offset. On paper it looks equal. A $500,000 house and a $500,000 401k seem like an even trade. But this is a mathematical illusion. The house is bought with after-tax dollars and may have a primary residence capital gains exemption. The 401k is pre-tax money. That $500,000 401k is actually only worth about $350,000 after the government takes its share during retirement. In the West, where home values have skyrocketed in cities like Boise or Phoenix, people are trading away their liquid retirement future for house-rich, cash-poor stability, often to their own long-term detriment. We must also consider the valuation date conflict. In California, the community property interest usually ends on the date of separation, the day one spouse moves out or clearly signals the end of the marriage. In other states, the interest continues until the date of divorce, which could be 2 years later. If your 401k grows significantly during the 2 years it takes to litigate your divorce, who gets that growth? In Nevada, the Hunt Rule, or the Van Camp/Pereira, formulas might be applied to determine how much of that growth is due to your personal efforts versus just market performance. These are complex calculations that require forensic accountants, especially in the high-stakes tech and energy sectors of the West where stock options and 401k matches are massive. This is why this deep dive is essential. We aren't just talking about a bank account, we are talking about the legal anatomy of your future. Every decision made in these early stages, how you define separate property, how you time your QDRO, and how you account for tax liabilities, will dictate whether you can actually afford to retire in the West or if you'll be forced to move to a lower-cost region just to survive. The rules of the frontier have changed, and the new law of the land is written in the fine print of your 401k plan summary. To understand the gravity of the 401k division in 2026, we have to look at the math of the modern American worker. As of this year, the IRS has increased the 401k contribution limit to $24,500, with those over 50 able to contribute an additional $8,000 in catch-up contributions. For a high earner in a place like Silicon Valley or the tech hubs of Austin and Salt Lake City, a decade of maxing out these contributions, combined with employer matching, can easily result in a balance exceeding $500,000. In a community property state, that entire sum is on the table. Imagine a couple we will call Sarah and Mark, living in Phoenix, Arizona, in early 2026. Mark has been a software engineer for 15 years, and his 401k is currently valued at $650,000. Sarah has spent the last decade growing a boutique consulting firm, which has high revenue but few liquid assets. When they decide to divorce, Mark assumes that because his name is the only one on the 401k statement, the money is his. He is wrong. In the eyes of Arizona law, every cent contributed and every dollar of market growth during their marriage is a community asset. The first step in their deep dive is the tracing exercise. This is a forensic accounting process where Mark must prove that a portion of the 401k existed before the wedding day. If Mark had $50,000 in the account on the day they said I do in 2011, that $50,000 is his separate property. But it is not just the $50,000. He is also entitled to the passive appreciation of that specific $50,000 over the last 15 years. However, if Mark cannot produce the statements from 2011, which many financial institutions purge after 7 to 10 years, the court may simply presume the entire $650,000 is community property. This lack of documentation is one of the most common ways Westerners lose hundreds of thousands of dollars in a settlement. Step 2 involves the valuation date, and this is where the volatility of 2026 becomes a factor. In the American West, the date used to value the 401k can be the date of separation, the date of the divorce filing, or the date of the final trial. Suppose Mark and Sarah separate in January 2026 when the market is at a peak. If their trial doesn't happen until August 2026 and the market has corrected by 15%, who bears that loss? If the court uses the January valuation, Mark might be ordered to pay Sarah a set dollar amount based on the peak, leaving him with a much smaller percentage of the remaining, deflated account. This is why historical trends show that savvy litigants push for a percentage-based split, rather than a fixed dollar amount to ensure both parties share the market risk until the moment of transfer. Step 3 is the drafting of the Qualified Domestic Relations Order, or QDRO. This is not a standard form you download from the internet. It is a highly technical legal instrument that must be approved by the plan administrator at Mark's company. One major pitfall in 2026 is the handling of outstanding 401k loans. If Mark took a $50,000 loan from his 401k in 2025 to renovate their kitchen, that loan is considered an asset by the plan. If the QDRO is written to give Sarah 50% of the account, does that include 50% of the debt of that loan? If Mark loses his job during the divorce, that loan could be deemed a taxable distribution, triggering immediate taxes. If the QDRO doesn't explicitly state who is responsible for the taxes on that loan, Mark could end up paying the IRS for money that was technically spent on a community asset. Furthermore, we have to look at the concept of the alternate payee's rights. Under federal law, Sarah, as the non-employee spouse, has the right to roll her share of the 401k into her own individual retirement account, or IRA. This is a tax-free event. However, if Sarah needs liquidity to start over, she can choose to take a cash distribution directly from the 401k. As we discussed, the 10% early withdrawal penalty is waived under a QDRO, but she still faces immediate federal and state income tax withholding. In a high-tax state like California, a $100,000 distribution might result in Sarah receiving only $65,000 after the plan administrator withholds the required taxes. +1. Case studies from 2026 show that many spouses fail to account for the hidden costs of the 401k division. Most plan administrators charge a fee to review and process a QDRO, ranging from $500 to $2,500. Additionally, if the account contains complex assets like company stock or non-publicly traded funds, the valuation process becomes even more expensive. In the West, where many employees receive restricted stock units or RSUs that are funneled into retirement vehicles, the math becomes exponentially more difficult. Now, consider the role of the employer match. In a community property state, if the employer's contributions have not yet vested, they may still be considered marital property. If Mark has $100,000 in unvested matching funds, the court may apply a time rule formula, often called a Lynch or Majowska's formula in legal circles. This formula calculates a fraction, the time Mark worked for the company while married divided by the total time he worked for the company to earn the benefit. This fraction determines Sarah's share of those future funds. Sarah might not see that money for another 3 years, but she has a legal claim to it today. Another often overlooked factor is the survivor benefit. If Mark were to pass away after the divorce but before the 401k funds were actually moved to Sarah, what happens? Without a specific provision in the QDRO naming Sarah as the surviving spouse for her portion of the benefit, the money could revert to the plan or go to a new beneficiary Mark named. This is why the open loop of the QDRO process is so dangerous. The time between the judge signing the divorce papers and the 401k company moving the money is a period of extreme financial vulnerability. As we move deeper into this masterclass, we have to address the equitable offset strategy. Some couples in the West try to avoid the QDRO entirely by trading other assets. For example, Sarah might agree to let Mark keep his entire 401k if she gets to keep the equity in their home in Austin, Texas. While this avoids legal fees, it often creates a massive tax imbalance. A $500,000 401k is not equal to $500,000 in home equity because the home equity is largely tax-free upon sale, while every dollar from the 401k will be taxed as ordinary income when Mark retires. In 2026, with shifting tax brackets and economic uncertainty, these even trades are rarely even. What happens when the 401k isn't the only retirement asset? In the American West, many professionals have a tiered retirement structure involving 401ks, traditional pensions, and deferred compensation plans. Each of these requires a different type of legal order and a different valuation method. If you use the 401k rules for a pension, the order will be rejected, and you may find yourself back in court years after you thought the divorce was over. But there is a darker side to this process that most people don't see until it is too late. There is a way that one spouse can technically follow the law, but still leave the other with nothing but a shell of an account. It involves the specific timing of investment reallocations and the ghosting of account access during the discovery phase of the divorce. If you think the 401k is the most complex part of a Western divorce, you haven't seen how the courts handle the Social Security offset and the public employee pension trap. In the next part, we are going to reveal why being a teacher, firefighter, or government employee in the West changes the 401k math entirely, and why your 401k might be used to subsidize a pension you aren't even allowed to touch. The intersection of a private 401k and a public sector pension is perhaps the most treacherous terrain in the Western legal landscape. In states like California, Nevada, and Colorado, many households are split between the private tech or service sectors and the public sector. Consider the case of David and Maria in Denver. In 2026, David has spent 20 years as a civil engineer for a private firm with a robust 401k, while Maria has spent those same 20 years as a public school teacher contributing to PARA, the Public Employees Retirement Association of Colorado. On the surface, both have worked hard for their respective retirements. However, the way the law treats these two pools of money is fundamentally different, and this difference often leads to a phenomenon known as the pension offset trap. Most public employee pensions in the West are defined benefit plans, meaning they pay out a set monthly amount for life based on years of service and final salary. A 401k is a defined contribution plan, which is simply a bucket of cash. When David and Maria divorce, the court must assign a present value to Maria's future pension. This requires an actuary to look at Maria's life expectancy, the projected cost of living adjustments, and the current interest rates in 2026 to determine what that monthly check is worth in a lump sum today. If the actuary determines Maria's pension is worth $800,000 and David's 401k is worth $600,000, the court might decide that David keeps his entire 401k, but he also technically owns $100,000 worth of Maria's future pension to make the split equal. But here is where it gets complicated for government employees in the West. Many public sector workers in states like California, Colorado, and Nevada do not contribute to Social Security. Instead, their pension is their sole safety net. Under federal law, Social Security benefits are not divisible in a divorce. If David has been paying into Social Security his whole life, Maria cannot touch his future Social Security checks. However, Maria's pension is divisible. To level the playing field, some Western courts utilize what is called a Social Security offset. They calculate what David's Social Security benefit is worth as a lump sum, and subtract that from the value of Maria's pension before they divide the remainder. If this calculation isn't performed with surgical precision, the public employee can end up losing a massive chunk of their only retirement source, while the private sector spouse walks away with both their 401k and their full Social Security entitlement. This leads us to the step-by-step reality of the Majoska's formula, a staple in Western family law. Imagine if David started his 401k 5 years before marrying Maria, and continued it for 15 years during the marriage. The court creates a fraction where the numerator is the number of months of participation in the plan during the marriage, and the denominator is the total months of participation. In this case, 15 years of marriage divided by 20 years of total work equals 75%. That 75% is the community property portion. Maria is entitled to half of that, or 37.5% of the total account. In 2026, with high-frequency trading and volatile market swings, the exact day you stop the clock on that numerator can change the settlement by thousands of dollars. If the date of separation is documented as January 1st, but contributions continue until the divorce is final in December, that entire year of contributions and growth could be contested. We also have to discuss the administrative freeze. The moment a divorce petition is filed in states like California or Arizona, an automatic temporary restraining order, or ATRO, typically goes into effect. This prevents either spouse from cashing out, transferring, or taking a loan against a 401k. However, the plan administrator at the company be it a massive aerospace firm in Los Angeles or a mining company in Nevada, doesn't automatically know you are getting divorced. If a spouse ignores the QDRO and withdraws $50,000 to retain a high-profile attorney, the 401k provider will likely process it. The court can later sanction that spouse or credit that $50,000 against their share of the assets. But if the money is gone and the remaining assets aren't enough to cover the difference, the other spouse is left holding an empty bag. Step 4 of this masterclass involves the concept of the Gilmore election. This is a specific legal right in the West, particularly prominent in California. Imagine David reaches the age where he could retire and start drawing from his benefits, but he chooses to keep working because he enjoys his career or wants a higher salary. Maria, his ex-spouse, doesn't want to wait for him to retire to get her share of the retirement benefits. Under a Gilmore election, Maria can demand that David pay her what her share would be if he were retired, even while he is still working. David would have to pay Maria out of his own pocket every month. This creates a massive cash flow crisis for the employee spouse, who is effectively paying a retirement tax to their ex while still clocking in 40 hours a week. Furthermore, we must address the specific risks of 401k loans in a high-interest environment like 2026. If a couple in Seattle took a 401k loan to pay for their child's college tuition just before the divorce, that loan is often treated as a community debt. However, 401k loans are tied to employment. If the spouse who owns the account is laid off during the divorce, the loan becomes due immediately. If it isn't paid back, it is treated as a taxable distribution. The resulting tax bill, which could be 30% or more of the loan balance, must be allocated between the spouses. Case studies show that many couples fail to include a tax allocation clause in their settlement, leading to a secondary legal battle with the IRS and the state tax board years after the divorce is finalized. Another layer of the American West's unique retirement landscape is the presence of the 403b and the 457 plan, commonly held by healthcare workers in massive systems like Kaiser Permanente or University of Utah Health. These plans often have different withdrawal rules than a standard 401k. For instance, a 457 plan allows for penalty-free withdrawals at any age once the employee leaves the job. If one spouse is awarded a 457 plan and the other a 401k of equal value, the spouse with the 457 plan has significantly more financial flexibility. They have access to cash without the 10% penalty before age 59 and a half, whereas the 401k holder is locked in. In a deep dive analysis, these plans are not equal, and treating them as such is a fundamental error. Data from 2025 and 2026 indicates that nearly 40% of divorcing couples over the age of 55 fail to properly execute their QDROs within the first year of divorce. They assume the divorce decree is enough. This delay is a ticking time bomb. If the employee spouse remarries and then passes away, the new spouse may automatically become the beneficiary of the 401k under federal law, overriding the divorce decree. The ex-spouse then has to sue the estate of the deceased and the new spouse, a process that is expensive, emotionally draining, and has no certain outcome. The complexity only increases when we look at the interaction between 401ks and the skyrocketing cost of living in the West. As housing prices in cities like San Diego or Bozeman remain high, the 401k is often the only liquid asset available to fund a move or a down payment on a new, post-divorce residence. But using a QDRO to extract cash is a one-way street. Once that money is pulled out of the retirement system and taxed, it loses the power of compound interest that is vital for surviving a 20 or 30-year retirement. This brings us to a critical realization. The 401k isn't just an asset, it's a tax-deferred engine. When you split it, you aren't just splitting money, you are splitting the future time that money would have bought you. But what if the account isn't actually a 401k? What if it's a solo 401k for a freelancer in the gig economy of Portland, or a SEPIRA for a small business owner in Wyoming? These accounts follow entirely different rules, and the QDRO doesn't even apply to some of them. In the next part, we are going to dive into the nightmare of the small business retirement split, where the line between your company and your retirement is blurred, and the wrong move could trigger an IRS audit that destroys both. When you move away from the corporate cubicle and into the world of the Western entrepreneur, the standard 401k rules get thrown out the window. In 2026, the gig economy and small business landscape in states like Oregon, Montana, and Wyoming are booming. But this independence comes with a heavy price tag during a divorce. Consider the case of James, a freelance consultant in Portland who operates as a sole proprietor. James doesn't have a HR department to manage a QDRO. He has a solo 401k, a powerful tool that allows him to contribute as both the employer and the employee. As of 2026, James can squirrel away up to $69,000 a year, or even more if he is over 50. But when James and his spouse decide to part ways, this solo 401k becomes a legal minefield because there is no plan administrator to act as a buffer. James is the plan administrator. In this scenario, the conflict of interest is immediate and intense. Imagine if James, fearing a massive loss, decides to change the investment strategy of the solo 401k mid-divorce, moving from aggressive growth stocks to low-yield bonds to deflate the perceived value of the account before the final valuation. In the American West, where courts have a low tolerance for fiduciary breaches, James could be found in violation of his duties not just as a spouse, but as a plan trustee. This could lead to a court-ordered audit of every transaction made in that account over the last 5 years. The step-by-step reality here is that for a solo 401k, you often need a specialized QDRO that is essentially a mirror of a corporate one but must be signed by the business owner themselves in their capacity as the employer. If James refuses to sign, his spouse may have to go back to court to get a contempt order, dragging the process out for years. Then we have the SEPIRA, or Simplified Employee Pension, a favorite for small business owners in the West. Here is the first major trap. IRAs are governed by IRA rules, not ERISA rules. This means a QDRO is technically not the correct instrument. You use a transfer incident to divorce under Internal Revenue Code Section 71. If your attorney or your spouse's attorney tries to force a 401k-style QDRO onto a SEPIRA, the financial institution will likely reject it, and in the meantime, the tax-deferred status of that money could be at risk. Historical trends show that many entrepreneurs accidentally trigger a taxable event by simply cutting a check from their business retirement account to their ex-spouse, thinking they will sort it out at tax time. In 2026, the IRS is more vigilant than ever regarding these unauthorized distributions. A $200,000 mistake here could result in an immediate $70,000 tax bill plus penalties, effectively wiping out the liquidity of the business. Let's look at a case study involving a ranching family in Wyoming. The retirement plan isn't a 401k. It's a complex web of land assets, a small business 401k for the ranch hands, and a deferred compensation agreement for the owners. In a community property state like Wyoming, the growth of that ranching business during the marriage is community property. If the husband, Robert, used his premarital 401k funds to buy a new tractor or to lease additional grazing land, he has commingled separate and community assets. The court then has to use the Moore-Marsden formula or similar Western legal precedents to determine how much of the current business value is tied to that original 401k investment. This is not just math, it is forensic genealogy. It involves looking at bank records from 2015 to see exactly where the 401k distribution landed and how it was used to generate income in 2026. Imagine if you are the spouse of a small business owner in a city like Las Vegas. You know there is a retirement account, but the business owner's spouse claims the account is worth zero because of business debts or market losses. In the West, discovery is your most powerful tool. You have the right to demand the summary plan description and the last 5 years of Form 5500 filings, which are public documents filed with the Department of Labor. These forms reveal the true health of the retirement plan. If the business owner has been using the 401k as a personal piggy bank, taking loans and not paying them back, or using plan assets to fund business operations, they are in deep trouble. In 2026, ERISA violations uncovered during a divorce can lead to Department of Labor investigations that far outweigh the cost of the divorce settlement itself. The step-by-step process for dividing a business-related 401k involves an extra layer of valuation. You must first value the business, then value the retirement plan, and then determine the crossover. For example, if the 401k owns shares in the family business, a common setup in certain ESOPs or employee stock ownership plans, splitting the 401k means splitting the ownership of the company. This could result in an ex-spouse becoming a minority shareholder in the company you are trying to run. To avoid this, many Western business owners opt for a buyout, where they use other assets to pay the spouse for their share of the retirement plan. However, as we have established, the tax-adjusted value of a 401k is different from the cash value of a house or a car. You must apply a discount for future taxes, often called a tax-impacted valuation, to ensure the buyout is equitable. Another emerging issue in 2026 is the presence of alternative investments within Western 401ks. Many self-directed 401ks in places like Utah or Arizona now hold non-traditional assets like private equity, real estate, or even precious metals. Dividing a 401k that holds a physical gold bar or a partial interest in a commercial strip mall in Phoenix is a logistical nightmare. You cannot simply roll 50% of a strip mall into an IRA. These assets must often be liquidated, sometimes at a loss, or one spouse must be given a lien against the asset until it is sold. This creates a long-term financial entanglement that goes against the very goal of a divorce, which is a clean break. Data suggests that for small business owners, the administrative cost of dividing these accounts is 30% higher than for W-2 employees. You are paying for the forensic accountant, the QDRO specialist, and often a business appraiser. In a case study from a tech startup in Boulder, the 401k division alone cost the couple $15,000 in professional fees because the plan was so poorly documented. The entrepreneur had been so focused on growth that they neglected the compliance side of their solo 401k, and the divorce brought those skeletons out of the closet. Furthermore, we must address the issue of the fiduciary's liability. If you are the business owner and the plan trustee, and you fail to move the money to your ex-spouse in the timeframe specified by the QDRO, you can be sued personally for any market gains your ex-spouse missed out on. In 2026, with the market showing rapid recoveries followed by sharp dips, a 2-week delay in transferring funds can result in a 5% difference in account value. In the West, courts are increasingly awarding surcharges against the trustee spouse to compensate the non-employee spouse for these delays. But what happens when the 401k isn't just a 401k, but part of a larger executive compensation package? In the high-stakes world of Western CEOs and executives, the 401k is often the smallest part of the puzzle. The real wealth is hidden in NQDC plans, non-qualified deferred compensation. These plans do not follow ERISA. They are not protected by the same laws as your 401k, and in many cases they can be forfeited entirely if the company goes bankrupt or the executive is fired. If you trade your 401k for a share of your spouse's NQDC plan, you might be trading a sure thing for a high-risk gamble. As we conclude this deep dive into the business owner's nightmare, we have to look at the ultimate trap. There is a specific federal law that allows a 401k to be used to pay for something other than retirement or a spouse's share. It is the only way a 401k can be legally rated before the divorce is even over, and it has to do with the most high-stakes obligation a parent can have. In the next part, we are going to explore the 401k and child support, and how a QDRO can be used as a weapon to seize retirement funds for unpaid obligations, potentially leaving the account owner with nothing for their golden years. The intersection of family law and retirement security takes its most aggressive turn when child support enters the arena. Most people view their 401k as an untouchable fortress, protected by the Employee Retirement Income Security Act from general creditors, lawsuits, and bankruptcy. However, the federal government has carved out a massive exception for domestic relations. In the American West, where the cost of raising a child in cities like Seattle or Los Angeles has reached historic levels in 2026, the 401k is no longer just a retirement vehicle. It has become a primary source of collateral for unpaid child support and alimony. Imagine a scenario in 2026 involving a father we will call Michael, a high-earning project manager in San Francisco. Michael has a 401k valued at $800,000. Following a contentious divorce, Michael falls behind on his child support payments due to a series of lifestyle changes and high legal fees. In many other jurisdictions, the state might garnish his wages or put a lien on his property. But in the West, the court can issue a specialized QDRO specifically for the collection of child support arrears. Unlike a standard property division QDRO, which splits the account during the divorce, this support QDRO can reach into the 401k to satisfy past due, current, and even future support obligations. The step-by-step reality of this process is brutal for the account holder. First, the custodial parent's attorney files a motion to show that Michael is in arrears. Once the court confirms the debt, they can order the 401k plan administrator to liquidate a specific dollar amount from Michael's balance to pay the custodial parent directly. This is not a loan, it is a permanent withdrawal. Here is the part that catches most Westerners off guard: the tax liability. Normally, the person receiving the money from a 401k via a QDRO is responsible for the taxes. However, in the case of a child support QDRO, federal tax law generally dictates that the participant, Michael, is the one who must pay the income tax on the money used to pay his child support. Michael effectively pays the debt with $100,000 of his 401k, but the IRS treats it as if he took the money himself, leaving him with a massive tax bill on money he never actually touched. This leads us to a deeper look at the 2026 landscape of high-stakes alimony, often referred to in states like California as spousal support. In the West, courts are increasingly looking at 401k assets as a way to provide a lump sum buyout of future alimony. Imagine if Michael's ex-spouse, Sarah, is entitled to $5,000 a month in support for the next 10 years. Rather than relying on Michael's monthly checks, which could stop if he loses his job or moves abroad, Sarah's legal team might propose a lump sum alimony QDRO. They calculate the present value of that $600,000 total obligation and take it right out of the 401k on day one. For Sarah, this provides immediate security and removes the need for future interaction with Michael. For Michael, it means his $800,000 retirement fund is instantly gutted, leaving him with only $200,000 to rebuild his entire future from scratch at age 50. Case studies from 2026 show that this strategy is becoming the preferred method for Western judges to achieve a clean break. The court system is overwhelmed, and they want to minimize future litigation. By using the 401k as a clearinghouse for all financial obligations, property division, child support arrears, and alimony, the court can effectively end the financial relationship between the two parties in one fell swoop. However, the long-term historical trend suggests that the spouse who gives up the 401k often underestimates the loss of compound interest. A $400,000 withdrawal today doesn't just cost $400,000, it costs the $1.2 million that money would have potentially grown into over the next 15 years. We must also analyze the phenomenon of the involuntary distribution. In states like Arizona and Nevada, if a spouse is found to have intentionally wasted marital assets, a concept known as waste or dissipation, the court can award the innocent spouse a larger share of the 401k as a form of reimbursement. Imagine if Michael spent $50,000 of community funds on a luxury vacation with a new partner while the divorce was pending. The court won't just tell him to pay it back. They will often simply move $50,000 from his side of the 401k ledger to Sarah's side. This is a seamless transfer that doesn't require Michael to have the cash on hand, making it a very effective and common punishment in Western divorce courts. Step 5 of our deep dive focuses on the 401k as a security interest. In complex Western divorces, one spouse might be ordered to pay the other a large sum of money over 5 years for a business buyout. To ensure this happens, the court can place a QDRO-based lien on the 401k. This means Michael cannot move his 401k, change providers, or take a loan without Sarah's written consent until the debt is paid. In 2026, with the frequency of job hopping in the tech and aerospace sectors, this can be a major career hurdle. If Michael wants to leave his job for a better opportunity, his 401k must usually be rolled over or liquidated. If Sarah has a lien on it, she can effectively block his career move unless he pays her the full remaining balance of the buyout immediately. Furthermore, we need to address the 2026 reality of healthcare and the 401k. In the American West, many older couples going through a silver divorce are terrified of losing health insurance. While the 401k is usually for retirement, we are seeing a trend where QDROs are being used to fund health savings accounts or to pay for COBRA premiums for a non-working spouse. The 401k becomes the emergency fund for medical stability. If a spouse has a pre-existing condition and the divorce will strip them of their coverage, a judge in Oregon or Washington might order a disproportionate share of the 401k to that spouse specifically to cover the projected high premiums of the 2020s insurance market. Data indicates that the psychological impact of losing 401k assets to support obligations is a leading cause of post-divorce litigation. The account holder often feels that their labor is being harvested to fund a life they are no longer part of. This often leads to attempts to hide 401k assets. In the digital age of 2026, some try to move 401k funds into self-directed plans that invest in hard-to-trace assets or offshore vehicles. However, the Western courts have become incredibly sophisticated at sniffing this out. Forensic computer experts can now trace the digital footprint of a 401k transfer across multiple platforms in a matter of hours. The penalty for hiding 401k assets in the West is often the forfeiture of the entire account to the other spouse. Imagine the risk of the double dip. This is a legal concept where a spouse receives half of the 401k in the property division, and then later asks the court to count the income generated by the remaining half of the 401k as income for Michael when calculating alimony. In some Western states, This is considered an unfair double dip. In others, it is perfectly legal. If Michael is 65 and starts taking distributions from his remaining 401k to live on, the court might see that as income and increase his alimony payments to Sarah, even though Sarah already got half of the original account. This is the ultimate trap for the high net worth individual in the West, the asset that keeps on taking. But there is an even more complex layer to this. What happens when the 401k isn't just a 401k, but a tool for international wealth? Many Western tech workers are foreign nationals with retirement accounts in their home countries and 401ks in the U.S. The QDRO does not work on an Australian superannuation fund or a British pension. How do Western courts balance the domestic 401k against a foreign asset they cannot touch? In the next part, we are going into the international 401k conflict, where the laws of the American West collide with the global economy, and how a simple mistake in your 401k disclosure can lead to a worldwide asset freeze. The globalization of the workforce in 2026 has created a specialized financial crisis for the courts in the American West. From the tech corridors of Seattle to the semiconductor hubs in Arizona, a significant portion of the population consists of foreign nationals or dual citizens who have spent parts of their careers working abroad. This introduces the international 401k conflict, a scenario where the domestic simplicity of a community property split meets the rigid, often contradictory laws of foreign nations. In the West, a judge has the power to order the division of a 401k sitting in a bank in San Francisco, but that same judge has zero jurisdiction over a pension fund in London, a superannuation account in Sydney, or a provident fund in Bangalore. Imagine a character named Elena, a high-level executive at a global aerospace firm in Los Angeles. Over her 20-year career, Elena worked for 5 years in Germany and 3 years in Singapore before settling in California for the last 12. She has a robust U.S. 401k valued at $900,000, but she also has substantial retirement credits in the German statutory pension insurance system and a private account in Singapore's Central Provident Fund. When Elena and her husband Thomas decide to divorce in 2026, the California court views the marriage as a single economic partnership. However, the court faces a jurisdictional wall. Step 1 in this international deep dive is the valuation of global credits. Since a California judge cannot issue a QDRO to a German or Singaporean entity, they must use the concept of an offset through domestic assets. The court will hire a cross-border actuarial expert to determine the present value of Elena's foreign holdings in US dollars. If those foreign accounts are worth a combined $500,000, and the U.S. 401k is worth $900,000, the court may award Thomas a much larger slice of the domestic 401k to compensate him for the fact that he cannot legally touch the foreign money. Thomas might walk away with $700,000 of the 401k, while Elena keeps the remaining $200,000 plus her $500,000 in foreign assets. But here is the high-stakes trap of 2026: tax disparity. The domestic 401k is pre-tax money subject to U.S. income rates. The foreign assets may have entirely different tax structures. If the Singaporean funds are tax-exempt upon withdrawal but the U.S. 401k is taxed at 35%, an even dollar-for-dollar trade is a mathematical failure. Historical trends in Western courts show that if your legal team does not account for the net after-tax value of international assets, one spouse can end up with a portfolio that is functionally 20% smaller than it appears on paper. Now, consider the risk of the worldwide asset freeze. In a contentious Western divorce, if one spouse suspects the other is funneling 401k distributions into offshore accounts to hide them, they can petition the court for a mar eva injunction or a similar freezing order. While these are traditionally used in commercial litigation, in 2026, they are appearing in family law cases involving high net worth individuals in the West. If the court finds evidence of an undisclosed foreign pension, they won't just look at that account. They can freeze the domestic 401k entirely, preventing any trades, reallocations, or loans until a full international audit is completed. This can paralyze a retirement strategy for years, leaving the assets vulnerable to market downturns without the ability to hedge or move to safety. Furthermore, we must address the 2026 reality of the totalization agreements. The United States has bilateral Social Security agreements with over 30 countries. These agreements allow workers to combine credits earned in different countries to qualify for benefits. In a Western divorce, these credits are marital property. If Elena's time in Germany helps her qualify for a higher U.S. Social Security payout, that increase is arguably a community asset. Calculating the specific value of a totalization credit requires a level of expertise that most general practice divorce attorneys do not possess, leading to what we call the silent leakage of retirement wealth. Step 2 involves the interaction of the QDRO and the tax treaty. If a non-resident alien spouse is awarded a portion of a U.S. 401k, the withholding rules change. Normally, the 401k provider withholds 20% for federal taxes. However, if the receiving spouse lives in a country with a specific tax treaty with the U.S., that rate could be lower, or the distribution could be subject to immediate 30% backup withholding if the paperwork is filed incorrectly. Case studies from 2026 show that many ex-spouses living abroad are shocked to find their awarded portion of a 401k significantly diminished by unexpected treaty-related tax grabs. We also have to look at the currency exchange trap. Between the date a Western judge signs the order and the date the 401k funds are converted or offset against foreign currency, the exchange rate can shift. In 2026, with global economic shifts, a 5% move in the euro or the yen can mean a $25,000 difference in the final settlement value. Who bears the risk of that fluctuation? Without a specific clause in the settlement agreement stating that the valuation is pegged to a specific date and exchange rate, Western litigants often find themselves back in court arguing over who owes the difference caused by the global forex market. Imagine the scenario of a tech worker in Austin who has been contributing to a 401k, while their spouse lives in a country that does not recognize Western divorce decrees. If that spouse is awarded half of the 401k via a QDRO, but their home country's tax authorities view that transfer as a gift rather than a divorce settlement, they could be hit with a massive gift tax in their jurisdiction. This is the double taxation nightmare that is becoming increasingly common in the multinational households of the West. Data from the last 2 years indicates that international retirement conflict is one of the top reasons for delayed final decrees in the American West. The sheer amount of time required to get verified statements from foreign government-controlled pension funds can exceed 18 months. During this time, the domestic 401k remains in a state of legal limbo. The account holder might be stuck in a high-risk investment mix they want to exit, but the court-ordered freeze prevents them from moving to a more conservative posture during a market crisis. This brings us to a critical realization for the globalized worker in 2026. Your 401k is not an island. It is part of a complex web of international treaties, tax laws, and jurisdictional limits. If you fail to disclose a foreign account, even a small one, you risk a finding of fraud that can result in the court awarding your entire domestic 401k to your spouse as a penalty. In the West, transparency isn't just a suggestion, it's a survival tactic. But even if you perfectly navigate the international waters and the tax traps, there is another predator waiting in the wings. It is something that affects almost every 401k in the West, yet it is rarely mentioned in the divorce papers until the very end. It is the hidden hand of the plan administrator. In the next part, we are going to expose the secret veto power of 401k companies, why they reject thousands of QDROs every year, and how a single misplaced comma in your legal paperwork can cost you 3 years of retirement growth and tens of thousands in extra legal fees. The secret veto power of the 401k plan administrator is the invisible wall that stops a divorce settlement in its tracks. Most people assume that once a judge in a Western court signs the paperwork, the deal is done. But in the world of ERISA-governed accounts, a state court judge is not the highest authority. The plan administrator, the entity at a corporation or a third-party firm that manages the retirement fund, is the final gatekeeper. They have a fiduciary duty to the plan, not to you or your ex-spouse. If the language in your court order does not perfectly align with the specific internal governing documents of the 401k plan, they will reject it. This is not a rare occurrence. Historical trends suggest that a significant percentage of first-draft QDROs are sent back for revision, often for reasons that seem trivial to a layman but are monumental to a compliance officer. Imagine a character named Jennifer, a project manager in Salt Lake City. After 2 years of litigation, Jennifer and her ex-husband finally reach a settlement in mid-2026. The judge signs an order stating that Jennifer is entitled to 50% of the 401k as of the date of separation. Jennifer's attorney submits the order to the plan administrator. 3 weeks later, a letter arrives, rejected. The reason? The plan administrator's internal rules require that the order specify whether the 50% includes or excludes outstanding loans, and it failed to define the exact method of interest calculation for the period between the separation date and the distribution date. This is the beginning of the administrative loop. While the attorneys argue over the new language, the market continues to move. In a volatile 2026 economic climate, that 3-month delay while the paperwork is revised can result in the account value shifting by tens of thousands of dollars. If the market drops, Jennifer might receive 50% of a much smaller pie than she anticipated. If the market rises and the order was written for a specific dollar amount rather than a percentage, Jennifer misses out on all the gains that occurred during the delay. Step 1 in avoiding the administrator's veto is obtaining the Summary Plan Description or SPD. Every 401k plan in the West, from the smallest startup in Boulder to the largest tech giant in Cupertino, is required by federal law to provide this. However, the SPD is often 100 pages of dense legalese. Within those pages is a section on QDRO procedures. Some plans require very specific wording for the alternate payee's rights. For example, if the plan only allows for a lump sum distribution but your court order asks for a monthly annuity, the administrator will reject it immediately. They will not change their plan to accommodate your divorce. You must change your divorce to accommodate their plan. Step 2 is the use of model language. Most large plan administrators provide a template or model QDRO. Many attorneys in the West make the mistake of thinking their own custom-drafted document is superior. In reality, using the administrator's preferred template is often the fastest path to approval. However, you must read the fine print of that template. These models are often written to favor the plan's administrative ease, rather than the financial interests of the spouses. If the model language defaults to a valuation date that is unfavorable to you, you have to know how to negotiate that specific clause while keeping the rest of the document within the administrator's comfort zone. Let's look at a case study involving an aerospace employee in El Segundo. The 401k plan had a very specific rule regarding company stock held within the retirement account. The divorce decree ordered an equal split of the total value. However, the plan administrator refused to split the actual shares of stock, insisting instead on liquidating the stock and transferring cash. This liquidation triggered a massive internal accounting shift and prevented the non-employee spouse from benefiting from a subsequent surge in the company's stock price. Because the original legal order didn't specify the handling of in-kind transfers versus cash liquidations, the spouse was stuck with the administrator's default policy. There is also the issue of the 401k administrative fee. In 2026, it is becoming standard practice for plan administrators to charge for the review and processing of a QDRO. These fees can range from $500 to over $2,500 per order. In the American West, where many couples have multiple retirement accounts from various employers, these fees can stack up quickly. If your settlement agreement doesn't state who is responsible for paying these fees, the participant, the alternate payee, or a 50-50th split, the plan administrator may refuse to process the order until they receive payment. This creates yet another bottleneck in an already exhausted legal process. Furthermore, we have to talk about the 401k blackout period. This is a time frame, often occurring during a corporate merger or a change in plan providers, where all transactions are frozen. If your QDRO arrives at the administrator's office during a blackout period, it will sit on a desk, unprocessed, for weeks or months. In the fast-moving corporate environment of the West, where companies are frequently bought and sold, timing is everything. Case studies from 2026 show that dozens of divorcing couples in the Silicon Forest of Oregon were caught in a 6-month limbo because their QDROs were submitted exactly when their employer was transitioning to a new retirement plan vendor. Another technical trap is the successor spouse clause. If the employee spouse remarries before the QDRO is finalized, the new spouse may gain certain rights to the 401k under federal law. If the QDRO is not yet qualified, the plan administrator might be legally obligated to recognize the new spouse's claim to a survivor annuity, which can reduce the amount available to the ex-spouse. This is why many Western attorneys now push for a joinder. This is a legal process where the 401k plan itself is joined as a party to the divorce case. It puts the plan on formal notice that a claim is pending, which can prevent the administrator from allowing the participant to take out loans or change beneficiaries while the QDRO is being perfected. The step-by-step reality of the QDRO journey is draft, pre-approval, execution, and qualification. Pre-approval is the most critical and most skipped step. You send the draft to the administrator before the judge signs it. They tell you what's wrong, you fix it, and only then do you go to court. Skipping this step in a Western court is a recipe for a multi-year headache. Historical trends show that couples who seek pre-approval finish their asset division 4 months faster on average than those who don't. Data suggests that the administrative burden of retirement division is one of the primary drivers of legal malpractice claims in the West. If an attorney tells you a QDRO is a simple form, they are underestimating the complexity of ERISA compliance. One missing digit in a social security number, a misspelled middle name, or an ambiguous statement about how to handle dividends can lead to a rejection letter that starts the entire 6-month clock over again. In the West, time is money, and in a 401k divorce, the plan administrator controls the clock. This administrative struggle is exhausting, but it is only the technical side of the battle. There is a much more personal and often more devastating conflict that occurs when the 401k isn't just a number, but a lifeline for a specific type of worker. We are seeing a rise in gray divorce in the West, where couples in their 60s and 70s are splitting accounts that have been built over 40 years. In these cases, the 401k isn't about the future, it's about the right now. In the next part, we are going into the silver tsunami of 401k divorce, and the specific rules that apply when you are already taking distributions, including the danger of the required minimum distribution trap that can trigger massive IRS penalties for both parties. The silver tsunami is not just a demographic shift. It is a legal and financial hurricane hitting the family courts of the American West in 2026. As the baby boomer generation and older Gen Zers navigate the complexities of late-life dissolution, the 401k is no longer a theoretical future nest egg. It is a live, active income stream. When a couple in their late 60s or 70s divorces in a community property state like Nevada or California, they aren't just dividing an account, they are dividing their survival mechanism. The stakes are elevated because unlike a 30-year-old who has decades to recover from a poor settlement, a 70-year-old has a 0-year horizon for error. Imagine a character named Robert, a retired aerospace consultant living in Henderson, Nevada. It is June 2026. Robert is 73 years old, and his ex-wife Linda is 71. Robert's primary asset is a $1.2 million 401k that he has already begun drawing from to fund their retirement lifestyle. Because Robert is over the age of 73, he is subject to the IRS required minimum distribution or RMD rules. Under the Secure 2.0 Act, which has fully integrated into the tax landscape of 2026, Robert must withdraw a specific percentage of his account every year and pay ordinary income tax on it. If he fails to do so, the penalty is a staggering 25% of the amount that should have been withdrawn, though it can be reduced to 10% if corrected quickly. The first step in the RMD trap occurs during the pendency of the divorce. If the 401k is frozen by a preliminary injunction while the lawyers argue over the division of assets, Robert might be legally barred from moving money. However, the IRS does not care about your divorce proceedings. The RMD must be taken by December 31st. If the 401k provider refuses to release funds because of the divorce freeze, Robert could find himself facing a 25% penalty on a 6-figure distribution requirement. Historical trends in Western courts show that many attorneys fail to include a specific carve-out in the freezing orders to allow for RMDs, leading to unnecessary and massive losses to the federal government. Step 2 involves the division of the RMD obligation itself after the QDRO is finalized. If the $1.2 million account is split 50-50, both Robert and Linda now own $600,000 in their respective accounts. However, the RMD calculation for the year of the split is often based on the balance of the account as of December 31st of the previous year. If the transfer happens in July 2026, who is responsible for the distribution that was required for the first half of the year? If Robert already took out $20,000 in March to pay for expenses, does Linda get a credit for that? In the West, forensic accountants must perform a mid-year reconciliation to ensure that the tax burden and the distribution benefits are shared equitably. If the QDRO is silent on this, the person whose name was originally on the account, Robert, might end up being taxed on the entire year's distribution even if Linda received half the money. Let's look at a case study involving a retired couple in Palm Springs, California. The husband had a 401k and was already receiving monthly distributions under a systematic withdrawal plan. When the QDRO was implemented, the plan administrator stopped all payments to the husband to recalculate the new balances. This administrative pause lasted 4 months. For a retiree who relies on that check to pay for supplemental Medicare insurance and housing, a 4-month blackout is a life-altering crisis. In 2026, We see an increase in emergency ex parte motions in Western courts specifically to compel plan administrators to maintain a status quo of distributions during the QDRO processing period. The third step in this masterclass is the analysis of the 72T distribution. Some individuals in the West retire early, perhaps at 55, and begin taking substantially equal periodic payments or SEPs under IRS Rule 72T to avoid the 10% early withdrawal penalty. If you are in the middle of a SEP series and you divorce, splitting the 401k via QDRO can potentially break the series. If the series is broken, the IRS may retroactively apply the 10% penalty to every withdrawal taken since the beginning. This can amount to hundreds of thousands of dollars in penalties and interest. In 2026, Specialized Tax Counsel is required to draft the QDRO in a way that the IRS views as a non-modifying event, preserving the 72T status. Most general divorce practitioners are completely unaware of this risk, leading to what is known as the 72T landmine. Furthermore, we must address the silver divorce housing crisis in the West. In cities like Seattle or Denver, a 70-year-old cannot easily qualify for a 30-year mortgage. Often, the only way for the non-employee spouse to secure housing after the divorce is to take a large cash distribution from the 401k via the QDRO to buy a home outright. As we established, the 10% penalty is waived, but the income tax is not. If Linda takes $400,000 out of the 401k to buy a townhome in Boise, she might effectively be pulling $600,000 out of the retirement pool once the state and federal taxes are withheld. This massive depletion of the principal means her remaining $200,000 in the 401k will likely not generate enough interest to cover her daily living expenses for the next 20 years. Case studies show that women in silver divorces are statistically at a much higher risk of poverty in their 80s because they traded long-term retirement growth for short-term housing stability. Another layer of complexity in 2026 is the beneficiary revocation. Many Western states have revocation by operation of law statutes. This means that if you name your spouse as the beneficiary of your 401k, and then you get divorced, the designation is automatically revoked. However, ERISA, the federal law, often preempts or overrides these state laws. This was the basis of the famous Egelhoff versus Egelhoff Supreme Court case. If Robert dies in late 2026 and he never updated his beneficiary form after the divorce, the 401k company might be legally required to pay the money to Linda, even if the divorce decree said she waived all rights to it. This creates a nightmare scenario where Robert's children from a previous marriage must sue Linda in federal court to recover the funds. The takeaway is simple. Never rely on the law to fix your paperwork. The moment the judge signs the decree, the beneficiary forms must be updated manually. We must also consider the role of long-term care insurance. In 2026, many Western couples have hybrid long-term care policies that are funded through their retirement accounts or 401k linked annuities. Dividing these policies is almost impossible. If one spouse needs nursing home care and the other doesn't, how do you split the 401k without destroying the policy that pays for the care? Western judges are increasingly using alimony in kind, where one spouse is ordered to maintain the 401k and the associated insurance policy for the benefit of the other, rather than splitting the account and losing the coverage. Data from 2025 and 2026 indicates that the number of QDROs filed for participants over age 65 has increased by 22% compared to the previous decade. This has led to a backlog in the court systems of the West. In states like Colorado, it can take 6 months just to get a hearing on a disputed QDRO clause. During this time, the retiree is in a state of financial paralysis. They cannot rebalance their portfolio, they cannot change their withdrawal rate, and they are stuck in a legal waiting room while the market fluctuates. The silver divorce is the ultimate test of the 401k's durability. It proves that the account is not just a spreadsheet entry. It is a complex legal entity that reacts violently to being severed. But even if you survive the RMD traps and the tax withholdings, there is one final frontier that is catching the 2026 workforce by surprise. It is the rise of the digital asset 401k. Many Western companies are now allowing employees to hold Bitcoin or other digital assets within their 401k plans. In the next part, we are going to explore the high volatility nightmare of the crypto 401k divorce, where the value of the account can change by 50% between the time the judge picks up their pen and the time they finish their signature. The high volatility nightmare of the crypto 401k divorce represents the newest and most unstable frontier in Western family law. As of 2026, the landscape of retirement investing has shifted dramatically. Major institutional providers and specialized self-directed 401k platforms now allow participants in states like California, Washington, and Utah to allocate a significant portion of their retirement portfolios to digital assets. This is no longer a fringe hobby. It is a structural component of many tech sector retirement plans. However, when these accounts enter the divorce courts of the American West, the traditional rules of 401k division are stretched to their breaking point. Imagine a character named Kevin, a senior developer at a blockchain infrastructure firm in Austin, Texas. Over the last 5 years, Kevin has utilized a self-directed solo 401k to invest heavily in Bitcoin and Ethereum. By the time he and his spouse, Amanda, file for divorce in early 2026, his account is valued at $1.2 million. In a community property state like Texas, Amanda is entitled to 50% of the community portion of that account. But here is the problem. Digital assets do not behave like mutual funds. Between the date of their legal separation and the date of the final hearing, the crypto market experiences a massive swing. The $1.2 million account drops to $600,000 in a 3-week window, then rebounds to $900,000 just as the judge prepares to sign the decree. The first step in this digital deep dive is the valuation date paradox. In a standard 401k divorce, courts often look at the balance on a specific quarterly statement. But in 2026, with 24/7 trading and extreme price discovery, a quarterly statement is ancient history. Western courts are increasingly being asked to use real-time valuation. This requires forensic experts to capture the precise price of the assets at a specific minute on the day of the trial. If the QDRO is drafted to award Amanda a fixed dollar amount of $600,000 based on an old valuation, but the total account has dropped to $500,000 due to a market crash, Kevin literally cannot fulfill the order. This is why historical trends in 2026 show a massive shift toward percentage-based unit splits. Instead of awarding Amanda dollars, the court awards her 50% of the specific number of Bitcoin or Ethereum units held in the account. Step 2 involves the technical transfer via QDRO. This is where the administrative veto power we discussed earlier becomes even more aggressive. Most traditional 401k plan administrators are not equipped to handle the transfer of digital assets to an ex-spouse. If the plan only allows for liquidation, Kevin is forced to sell his crypto to pay Amanda her share in cash. This triggers a massive opportunity cost if the market rallies immediately after the sale. Furthermore, if the crypto is sold within the 401k, the cash remains tax-deferred, but the portfolio's growth potential is fundamentally altered. Case studies from 2026 show that litigants are now fighting for in-kind transfers, where the actual digital assets are moved to a separate 401k or IRA for the ex-spouse. However, many Western retirement plans simply do not have the technical infrastructure to support this, leading to prolonged legal stalemates. Then we have the hidden asset audit. In the American West, the ease of moving digital assets has led to an increase in attempted dissipation. Imagine if Kevin, sensing the divorce is going poorly, transfers a portion of his 401k, held crypto to a private cold storage wallet that he claims was hacked or lost. In 2026, Western family law courts have integrated blockchain forensics into their discovery process. Experts can now trace the movement of funds from the 401k provider to any public wallet address. If the court finds that Kevin intentionally moved assets to a private wallet to hide them from Amanda, the penalties in states like California are severe. Under Family Code Section 1101, the court has the authority to award Amanda 100% of the hidden asset as a penalty for Kevin's breach of fiduciary duty. What started as a 50-50 split becomes a total forfeiture because Kevin underestimated the transparency of the ledger. Step 3 focuses on the tax basis and the 2026 tax trap. Digital assets often have a very low cost basis if they were purchased years ago. When a 401k is split via QDRO, the tax basis usually rolls over to the recipient. If Amanda receives $500,000 worth of Bitcoin that was originally purchased for $50,000, she is inheriting a massive future tax bill. If she decides to liquidate that Bitcoin upon receipt to buy a house in Denver, she will be taxed on the $450,000 gain at ordinary income rates, because it is coming out of a 401k. In the West, forensic accountants must now perform a tax-impacted valuation of crypto assets, discounting the present value of the crypto to account for the inevitable bite the IRS will take. Failure to do this results in an unequal split where one spouse gets clean cash, and the other gets a tax-heavy digital asset. We also have to look at the issue of security and custody during the divorce. Who holds the private keys while the case is pending? If Kevin is the only one with access to the 401k's digital vault, Amanda is at extreme risk. If Kevin loses the keys, the retirement for both spouses is gone forever. In 2026, Western courts are increasingly ordering the use of institutional escrow or multi-signature wallets. This requires both spouses or their attorneys to provide a digital signature before any crypto can be moved or sold. This provides a level of security, but it also adds significant cost and technical complexity to the divorce. Data from 2025 and 2026 indicates that crypto-involved 401k divorces take, on average, 8 months longer to finalize than traditional cases. The bottleneck is not just the law. It is the lack of qualified QDRO drafters who understand the nuances of digital custody. Many older attorneys in the West are still trying to treat Bitcoin like a mutual fund, leading to orders that are rejected by the emerging class of crypto-friendly retirement custodians. This creates a secondary market for specialized digital asset QDRO experts, whose fees are often double those of traditional practitioners. Furthermore, we must address the staking and yield trap. Many 401ks in 2026 participate in staking, where the digital assets earn a yield for securing a network. Who is entitled to the rewards earned during the 12 months it takes to get a divorce? If Kevin's 401k earned an additional 5% in Ethereum rewards while the case was pending, Amanda has a community property claim to half of that yield. If the QDRO only mentions the principal balance, Kevin walks away with the entire year's earnings. In the high-yield environments of the mid-2020s, this can be a difference of 5 or 6 figures. The volatility of the American West isn't just in the markets. It's in the changing nature of wealth itself. The 401k has evolved from a simple savings account into a complex, multi-asset digital engine. But as we reach the final stage of this masterclass, we have to face the most uncomfortable truth of all. Even if you get the valuation right, even if you navigate the crypto volatility, and even if the plan administrator accepts your order, there is one final mistake that can render the entire process meaningless. It is the mistake that happens after the papers are signed, when the lawyers have gone home, and the ex-spouses are left to manage their new, separate lives. In the final part of this series, we are going to reveal the post-divorce 401k collapse. We will look at why 30% of people who win their share of a retirement account in the West end up losing it all within 5 years due to the reinvestment fallacy and the overlooked secondary tax triggers of the late 2020s. We will conclude with the step-by-step recovery plan to ensure your 401k divorce isn't just a legal victory, but a genuine foundation for the rest of your life. The post-divorce 401k collapse is a phenomenon that often begins the very second the legal ink dries. In the American West, where the cost of living in 2026 continues to outpace national averages, the temptation to view a newly divided retirement account as a liquid piggy bank is the primary driver of financial ruin. We see this across the Sun Belt and the Pacific Northwest. Individuals who fought for years to secure their 50% share, only to see that wealth vanish within 60 months. This is not due to market crashes alone, but to the reinvestment fallacy and the failure to account for the secondary tax triggers that define the late 2020s. Imagine a character named Susan, a nurse in Seattle who just finalized her divorce in early 2026. After a grueling 2-year battle, she was awarded $450,000 from her ex-husband's 401k via a perfectly executed QDRO. Susan feels a sense of immense relief. She finally has the capital to move out of her expensive rental and put a down payment on a home in a more affordable suburb like Tacoma. However, Susan falls into the first trap of the post-divorce collapse, the cash-out leakage. Because the 10% early withdrawal penalty is waived for QDRO distributions, Susan decides to take $150,000 in cash, rather than rolling the full amount into an IRA. What Susan fails to realize is that in 2026, her combined federal and Washington state-level tax implications. Though Washington has no personal income tax, the federal bite is substantial, will eat a massive hole in that distribution. By taking the $150,000, she pushes herself into a higher federal tax bracket for the 2026 tax year. Instead of having $150,000 for her home, she ends up with roughly $105,000 after withholdings, while the remaining $300,000 left in the retirement account loses the critical mass needed for compound growth. Historical trends show that once a retiree dips into the principal for non-retirement expenses, the likelihood of that account lasting through their 80s drops by nearly 40%. The second stage of the collapse is the reinvestment fallacy. In the West, many newly single individuals feel a sudden urge to make up for lost time or to exert total control over their finances for the first time. Susan, feeling empowered, decides to move her remaining $300,000 out of the conservative target date funds her ex-husband favored and into high-growth, high-volatility tech stocks and green energy startups based in California. In the volatile market of 2026, without a diversified strategy, Susan is over-leveraged. If the tech sector faces a correction, she has no other assets to balance the loss. Unlike a couple who might have two 401ks to lean on, the divorced individual is a solo flyer. A 30% drop in a single-person household is a catastrophe. In a two-person household, it is a setback. Step 1 of the 2026 recovery plan is the immediate IRA rollover. To avoid the trap Susan fell into, the most effective strategy observed in successful case studies is the direct trustee-to-trustee transfer. You do not touch the money. You do not let it pass through your personal bank account. You move the 401k share directly into a traditional IRA or a Roth IRA, depending on the tax status of the original funds. This preserves the tax-deferred status and, more importantly, it removes the psychological temptation to spend the money on immediate lifestyle needs. In the West, where the pressure to maintain a certain lifestyle in cities like Scottsdale or San Francisco is intense, physical separation from the funds is a vital defense mechanism. Step 2 involves the reassessment of risk tolerance. Your risk profile as a married person is fundamentally different from your risk profile as a single person. In 2026, the American West is seeing a rise in what we call the lifestyle risk adjustment. You must calculate your new cost of living, which in a divorce often doubles because you no longer share the costs of housing, utilities, and insurance. If your 401k is now your primary safety net, your investment strategy must shift from aggressive growth to capital preservation and consistent income generation. A forensic look at your new budget is the only way to determine how much market risk you can actually afford to take. Step 3 is the implementation of the successor beneficiary strategy. As we discussed in previous sections, the failure to update beneficiary designations is a leading cause of post-divorce litigation. But in 2026, we go further. You must coordinate your 401k beneficiary forms with your new will and power of attorney. In states like Colorado or Oregon, if you name your minor children as direct beneficiaries of your 401k, the court may appoint a guardian to manage the money until they turn 18, which can be expensive and restrictive. Instead, successful post-divorce planning often involves naming a trust as the beneficiary, ensuring that your 401k assets are managed according to your specific wishes even after you are gone. Furthermore, we must address the secondary tax triggers of the late 2020s, specifically the sunsetting of certain provisions from the Tax Cuts and Jobs Act. As we approach the late 2020s, tax rates are projected to shift. If you are holding a large traditional 401k, you are holding a massive future tax liability. Case studies suggest that 2026 is a critical year for considering partial Roth conversions. By paying the tax now on smaller portions of your account, you can create a pool of tax-free income for the future. For a divorced person in the West, tax diversification is the ultimate hedge against a rising cost of living. Finally, the masterclass concludes with the maintenance of the QDRO records. Even after the money is moved, you must keep a certified copy of the QDRO and the final plan administrator approval letter in a secure digital vault. We are seeing cases in 2026 where, decades after a divorce, a 401k provider claims a distribution was handled incorrectly or an ex-spouse attempts to claim a survivor benefit. Without the original paperwork, the burden of proof is on you. In the American West, where companies merge and records are lost in the digital ether, your paperwork is your shield. Imagine the potential outcomes if you follow this deep dive masterclass. You aren't just surviving a divorce. You are re-architecting your entire financial destiny. You have navigated the community property minefields of the West, outmaneuvered the plan administrator's veto, avoided the crypto volatility traps, and protected yourself from the silver tsunami of RMD penalties. You have taken a moment of total personal upheaval and turned it into a masterclass in financial resilience. The journey of the 401k in the American West is a reflection of the West itself. It is high stakes, it is governed by complex and shifting frontiers, and it rewards those who are prepared for the long haul. Your retirement is not a static number on a screen. It is the sum total of every legal and financial decision you have made during this process. By treating the division of your 401k not as an ending, But as the first day of a new, highly disciplined investment era, you ensure that your golden years remain truly golden, regardless of your marital status. As you move forward from this series, remember that the most dangerous phase is the one you are in right now, the phase of implementation. The knowledge you have gained here is only as powerful as the precision with which you apply it. The American West does not forgive financial ignorance, but it vastly rewards the diligent. This concludes our deep dive into the 401k divorce. Your future is now in your hands. Ensure you have the right professionals in your corner to turn these strategies into a reality that lasts for decades to come.